Hello students and welcome to the lecture. So students, as we know that we are covering the financial knowledge and the banking awareness part of it. Basically, in the previous lecture, we had completed with the banking history. I hope that you have revised the banking history before you have come for this lecture. Okay. So basically in this lecture, we are going to start with the part B of the banking awareness, which stands for the banking evolution. Okay. It is also very interesting topic. So let's start. Our main topic is the financial knowledge and the banking awareness part of it. And basically right now we are going to start with the banking evolution. Okay, how the banks evolved in India. All right. But before this, let me ask you one simple question. Is that what do you mean by the evolution? If I'm simply ask you, okay, hey you, tell me about the evolution. How you will describe it? That's the main fact. So basically, anything which is existed today, how it was, and how it had taken a shape as it is today. Is basically the evolution. Anything which is existed today and how it was and how it had taken a shape as it is today. Okay? Like if we talk the humans, then remember I had told you actually we were the ancestor of Australopithecus africanus. Right? We are the descendants of them, not ancestors. They were our ancestors. We are the descendants of them. Australopithecus africanus are basically the earliest ancestors of human beings. Right? About this, I had told you in the history. So, before 50 lakh years ago till today, this is the time period taken by the human beings to convert it from the Australopithecus africanus to the Homo sapiens Cro-Magnon. Alright, that is the time period we had taken to be evolved as Homo sapiens Cro-Magnon. This is called the human evolution. We were like the Australopithecus, then we became a Homo sapiens. How we had taken this shape, study of this is evolution. Similar things happen with the banks. Okay, if I'm asking you today, then we know the banking sector of India is very diversified. Okay, and much more activated than it was. Okay, because as we had discussed in the banking history, we are practicing the banking activities since the ancient time. Okay, and we were only dependent upon lending activities. But if we talk about today, then banks do investments. Okay, they accept payments, the deposits, bills of exchange, depositors, whatever we can see. All these things are the part of the banking evolution. All right. So now I think you have got a little bit clarity about the topic, like how the topic is going to be. All right. Now let's start it. So the first is the banking evolution in India. Banking evolution refers to the gradual and continuous development and transformation of the banking sector over time in response to various economic, technology, and regulatory changes. Actually, before this thing, let me tell you one thing. Need is the mother of innovation and invention. Need is the mother of innovation and invention. Who said this dialogue? This quote was given by Albert Einstein. As we know, he's a very famous scientist. Okay. So Albert Einstein told us that need is the mother of innovation and invention. It means that you only think about something when you felt need of that thing. All right. Like we discovered a television because we felt a need of entertainment. We discovered the mobiles because we need to communicate it with friends and family members, and because it was a need of communication. Okay. Similar things happen with the banking in India. Various things you are seeing today, like the investments, like the corporate banking, like the personal banking, saving account, demand draft, overdraft, whatever you are seeing today has been evolved over the time, evolved over the time due to the need of an hour or need of the time. We only evolved these things because we felt that we should require them. Okay. And this process is often gradual. What do you mean by gradual? Gradual means slow process and over the time process. Okay. It means that it is a very, you can say, slow path, but continuous path. Okay. It means, suppose if in the year of 2001, the banks introduced the payment structure. Just an example. Okay. So they took 2010 to develop a well-developed channel of demand drafts. Again, it's just an example. Do not take it as a real life examples. Okay. It's just an example I'm telling you. So it took them 9 years to shift from payment structure to the demand draft. Okay. So this is the slow process and over the time process. Okay. But it was a continuous process. It means that the efforts put, in this scenario were of continuous nature. Okay. Continuously, people felt that we required something like a demand draft for the last 10 years since the 2010. Thereafter, finally in the 2010, we got a demand draft facility. Okay. So that was the main thing. And the needs we felt from time to times were basically of the economic nature, of the technological nature, and of the regulatory changes for the well-being of economy and the banking sector. All right. It encompasses the historical progression of banking practices, adoption of new technologies, introduction of innovative financial products and services, and the implementation of regulatory reforms. Like, suppose during the ancient time when we started the banking activities, what we were doing exactly? What we were doing exactly? So basically, we were lending the loans, right? At something in return. Either interest, either collateral security, something was promised in returns if we lend a road. Okay. And if I'm talk about today, and whenever I ask you what is a banking activities, the first thing which comes in your mind is lending of loans at interest rate. Right? It's the first thing which comes in our mind when we talk about the banks. Okay. The same thing we were practicing in the ancient times and same thing we are practicing today. It means that we adopted the new technologies, but we still based on the historical facts and the historical practices we were doing. Okay. innovative financial products, services were also introduced over the period of time as per the economic needs. But the main thing is like regulatory reforms. Means we were adding new practices over the time for banking growth, which required proper regulation to control it. All right, because we had done something for something, and if the something which we had done gone for something, we return nothing. All right, that's why we required a proper regulation along with the introduction of the technologies. All right, in the context of the banking sector, evolution implies that the banks and the financial institutions have evolved and adapted to meet the changing in needs of customers, advancement in technologies, and the evolving economic landscape. It means that over the period of time, customers' needs changes, like no longer they are dependent upon the loans, but they also require the investments. Advancement in technologies means we replace the old method of withdrawing the money with the ATMs. Okay, and evolving economic landscape. Banks are now allowed to decide their own interest rate based on the ALCO's recommendation, which stands for Assets and Liabilities Committees. ALCO. Okay, and the interest rate is basically based on the market situation. Okay, however, the bank decide the interest rate as per their assets and liabilities, but they also measures the market competition. Okay, suppose bank's ALCO, after assessing the assets and liabilities, they could easily charge 8% interest rate. Okay, but in the market, their competitors are on 6% interest rate. So, what do you think? Is it favorable for XYZ to charge 8% interest rate from the customers? No, because the customers will switch off to the 6%. That's why evolving economic landscapes also made the banks to evolve themselves as per the current requirements. Okay. This evolution has resulted in the modernization of banking services, increased efficiency, improved customer experience. All right. Now, key aspects of the banking evolution involved. First is the historical development. History of banking has seen a transition from the ancient practices of money lending and credit instruments to the establishment of modern banks during the colonial era and the post-independence phase. Like, if you remember, we had discussed that the ancient times or the Vedas basically had a mention about the predatory loans. Right? Okay. What do you mean by the predatory loans? I had told you already. All right. Whereas when we entered in the modern era, we had a mention of which? Adesh, which is some kind of bills of exchange. Right? Thereafter, when we entered in the Mughal time period, basically we had a evidence of loan deed and investment by the government known as Dastavej. Okay. And finally, when we entered in the British era, then it was a 1770 when we had the first Bank of Hindustan which is first banking institution. So from ancient time, when we only focusing on the predatory loans, which is a type of money lending, and then we focus on the adesha credit instruments or bills of exchange, we had evolved for the investments, and then we have the first banking institutions. So this is the historical development which took place in context of the Indian banking evolution. Thereafter, we had the technical advancements. Advent of technology, banking has evolved from traditional brick and mortar branches to digital banking, mobile banking, and online transactions. If you remember, suppose this is a bank of XYZ. If you remember any bank from your childhood where your parents had their bank accounts, and if I talk about 2004, 5, and 7, okay, that was a time when there are banks like XYZ, then they will have their branch in some city like A, some city like B, okay, some city like C, some city like D, all right. And if you are a customer of XYZ, okay, and you lives in a city E where there is no branch of XYZ, okay. So if you want to use the services of XYZ for money withdrawal, for loan application, for investment purpose, for any other purpose, you have to move either of the cities like A, B, C, D, or XYZ itself, because these are the only branches where you could go and avail the services offered by the XYZ. All right. But if we talk about today, okay, if we talk about today, suppose you are living in E, whereas there is no branch of XYZ, but you want to avail the services of XYZ. So you are no longer required to move yourself to any of the city where the XYZ having its branches, but you can use either the website of XYZ or mobile application of XYZ. Okay, by visiting the mobile or the website, you can avail various services providing by the XYZ by yourself at your home. This is known as the digital banking and mobile banking. Okay, and the second thing is that, let me tell you one thing. Suppose this is you. Okay, this is me. Okay, you are the buyer, I am the seller. You had purchased something from me for rupees 10,000. Okay, so if you want to pay me rupees 10,000, so if I talk about the, you can say the past years, then you have to give me the cash, or you have to make me a bill of exchange. And the most easiest way is making the check if you do not carrying the cash. Okay, these are the only ways through which you can pay me without having the cash. Okay, and these procedures are basically the long procedure. Either for bills of exchange or for check, I had to visit the bank, then I had to submit the particular bills of exchange or check with the bank, then the bank will examine them, and then the bank will pay me off. Okay, so it's a long process. All right, but with the evolution of UPI, which is known as Unified Payment Interface, which basically connects various banking platforms or institutions on one platform. You can easily scan my QR, or you can easily pay me on my phone number registered with any app using the UPI. For examples, you can take the examples of Phone Pay, Google Pay, Paytm, Amazon Pay, and so on. There are so many apps which could be used by the UPI to pay the, you can say, pay some price or pay the cash. Okay, so in this case, you had bought a rupees 10,000. You are no longer required to carry a cash 20,000 with me. I must have some QR and the phone number. Then you can scan the QR or dial the phone number in the UPI app and you can pay me 10,000. So this is the online transactions which brought a technological advancement in the banking sector. All right. Thereafter, the financial products and the services. Over the time, banks have introduced a wide range of financial products and services, including loans, saving accounts, fixed deposit, credit cards, insurance, mutual funds, and more. Okay, loans were already there. Saving accounts means the accounts where you deposits. All right. Thereafter, the fixed deposits, credit cards, insurance, and mutual funds. All right. And basically, if we talk about the accounts, then let me tell you one thing. Accounts generally having of two types: savings, which is also called as salaried, and thereafter the current, which is also known as trader account. Now, what is the difference in between them? Saving account is basically used by the normal people to submit their excess of money. Suppose you having rupees 10,000, rupees 5,000 is the expenditure you required, and the remaining 5,000 is your saving. So you can submit this amount to the saving accounts. Okay, but the current accounts is basically used by the merchants and the traders for continuous transactions. Okay, because on the saving accounts there are the limit on transactions. You could not cross the limit of transaction in one day or during a particular period of time. Okay, and even if we talk about the saving account and you are using any app, then you could not pay more than rupees 5,000 at a time if you are using the app for the first time or using the bank account for the first time. Okay, so that's why the saving accounts, which is also called the salaried account, having this kind of things. Whereas when we talk about the current account, then it does not having any limit. Okay, a multiple number of transactions could be carried out on it. All right, and remember one thing also, there is a overdraft facility on the current account which is not available on the saving accounts. What do you mean by it? Suppose you want to spend rupees 10,000 on something, but in your saving account you only having rupees 5,000. Then you are scanning the QR of a shop and you are trying to pay the rupees 10,000. Is it possible that you could pay rupees 10,000? Simply not. And the bank will notify you of having insufficient stock or insufficient balance, you can say basically. That you having insufficient balance in your account, you could not make this transaction. All right. Whereas instead of having the saving accounts, if you had the current account, okay, in current account your balance is 5,000 but you want to pay 10,000, and if you scan the QR, what will happen? Your payment will be made. So you can question me, if we only had rupees 5,000, then where from additional 5,000 rupees comes to the account? This is called the overdraft. It means that the 5,000 rupees has been granted to your account by the bank. and you have to pay it back after a certain period of time. Okay, that facilities is basically available on the current account. It means that whether you having a sufficient balance in your account or you do not having a sufficient balance in your account, if you want to pay at some place, you can pay it because you're having the overdraft facility. But if you're using the saving accounts, you could only pay the amount up to the amount present in your bank. Okay, so this is about the saving accounts. Whereas if we talk about the fixed deposit, then these are the deposits which are kept with the bank for a fixed duration of time. Okay, you could not borrow, you could not withdraw the amount before the time period, and the time period is generally between from 7 days to 10 years. During this time period, you could freeze your particular savings or accounts with the bank in the name of fixed deposits, and you are entitled to get fixed interest rate from the bank side periodically. Okay, for example, suppose you having rupees 10,000 in savings of you, and you have made a FD, fixed deposit, for 12 months. All right. So before 12 months, you could not borrow out your, you could not withdraw your 10,000. If you withdraw, the bank will charge a penalty on you because you are breaching the agreement. All right. And suppose if you do not withdraw the amount, then you will get a fixed interest rate against your FD. Suppose the bank has promised 10% per month to you. Okay, so you will get rupees 1,000 in your account as an interest every month. Okay, this is example of fixed deposits. Now about credit card. Credit card is basically similar to the, credit card is a part of plastic cards, which includes two types of card, credit card and the debit cards. Okay, debit card is basically used for withdraw money from bank account. Okay, suppose you need to withdraw a money, rupees 10,000 from your account, and then you reach the ATM. Okay, then you have seen that you have to put some card in the ATM machine, then you can withdraw the amount. The card which you put is known as the debit card, because you must have rupees 10,000 in your account if you want to withdraw 10,000 from bank. Okay, but the credit card is basically the overdraft facility. It's basically the overdraft facility. It means that you could use the credit card in the ATM to withdraw the rupees 10,000, whether you having that much account amount in your bank account or not. You could withdraw it, but after some time, you are required to pay it back to the bank. Okay. Thereafter, if we talk about the insurance, then it is basically some kind of, you can say, recover guarantee. Okay. Just, you can say, if we try to understand it, suppose you are the person who having a car. Okay. And you have made a rupees 10 lakhs insurance of it against the accident. So suppose, it's just an example, do not take it personally. If you struck with your car somewhere, all right, and then rupees 6 lakhs has been the expenditure occurred. Okay, in this scenario, you are not required to pay 6 lakhs. You are only required to pay rupees 3 lakhs. And the remaining 3 lakhs will be paid off by the insurance company. Okay, this is why it is called as a recover guarantee. It means that whenever some unforeseen incidents occurs in your life, you are required to pay half of the amount, and the remaining insurance amount will be paid off by the insurance company. In return of it, you have to give premium or fixed amount to insurance company on periodic basis. Okay. Thereafter, the mutual funds, they are basically the cooperative funds about which we had a discussion in the upcoming lectures. Okay. So students, basically in this lecture, we have learned some facts and figures about the banking evolution. In the next lecture, we will continue with the same topic. Till then, just revise all the facts and figures we have discussed in this lecture and be ready for the next lecture. With this note, let's end this lecture and thank you.